Europe's biggest oil company has delivered fourth quarter earnings ahead of estimates, led by upstream and gas. Shell reported adjusted profit of $4.3 billion, its best profit in 3 years, but with a surprise drop in cash flow. Let's speak to the CEO of Shell, Ben Van Beurden. He joins us for his first interview of the day. Ben, a profit beat. Let me ask what led to this, and if you see those, positive effects, these tailwinds going forward. I'm assuming pricing was a big part of it.
Yeah, good morning, Matt, and thanks for the opportunity. I think indeed a very good year, very good quarter. We're very pleased with our earnings. Basically, we saw improvements in all our main businesses, so improvements across the board. I think altogether the year has been, in my mind, a transformative year. Earnings close to $16 billion, sector-leading earnings. I think we have shown that we have what it takes to be a world-class investment case. Altogether, on a cash basis, we came out at $39 billion after working capital adjustments. We've been able to pay down our debt quite a bit, so we're now at a gearing below 25%. So I'm very confident that we can indeed meet the commitments, the promises that we made for the end of the decade, which is $25 to $30 billion free cash flow organically.
Why the weaker than expected from the market cash flow generation here, especially at $70 a barrel? An analyst at RBC says this could temper hopes of a buyback program in the very near term. How do you answer to that?
Well, first of all, of course, we have some seasonality and phasing in our cash flows. It is not abnormal for our Q4 to have some specials in it. I think in this particular case, first of all, you have to bear in mind that the run-up in oil price that we saw in the fourth quarter, of course, also results in a revaluation of our inventories. So if you add back the working capital changes as a result of that, you get to about $8.4 billion of cash in the quarter. Now, the other thing that happened this quarter is, of course, that we paid significantly higher taxes. Part of it, of course, is because we made more profits, but also we had some specials, some one-offs in the context of tax case settlements, etc., which is essentially very good news, but nevertheless a higher cash tax bill. If you look at the differences between this quarter and the same quarter last year, there's about $1.6 billion more tax payments in this quarter because of these one-offs. So if you add all of that back, actually, it's a very strong quarter from a cash perspective as well.
Can you quantify, Ben, the effects of the U.S. tax reform bill?
Yeah, so there's two effects, really. First of all, we have an effect on the deferred tax assets that we have on our balance sheet. So that's basically an effect on sort of the tax history, if you like. As a result of that, we had to take an adjustment on our deferred tax assets. That basically meant in this quarter, when we took it, a $2 billion non-cash hit to our earnings. But going forward, of course, it's very positive. The United States is our single biggest investment destination. We invest for the next few years, on average, again, $10 billion a year. So we are very well exposed to the United States. And that investment, of course, is going to be doing well in a much more advantageous tax environment. So for us, there is a very significant upside to the reduction in corporation tax.
Let me ask you about the future of Shell. As an oil company, you're already calling it a gas and oil company after the century of big oil. What's the next iteration of Shell? Is it a technology company? Is it a power company? Is it a chemicals company? How do you see it?
Why not all of the above, Matt? You're absolutely right. We have, over the years, we have shifted from an oil-rich portfolio much more to a gas-rich portfolio. On multiple measures, gas is bigger than oil, whether it's reserves, even in production. But of course, we are more than just oil and gas. We have a very well-performing and actually growing, fast-growing chemicals business. We see chemicals as a very advantaged segment to invest in. We are going to double our chemicals business in the next few years. And I would imagine that also through the 20s, we will see a continued focus on doing so. But then also, of course, there is a massive energy transition underway, and we want to be part of that energy transition as well. So what we have said, we're going to focus significantly more on what we call new energies. That is basically focusing on new types of fuels, think of hydrogen, biofuels, etc., but also focusing more on power. And you have seen us making the initial moves already in the last quarter, a few more moves also already this year. We are going to build up another value chain next to oil, gas, and petrochemicals. So we will have a much more sort of future-proofed portfolio, basically accessing Brent that we are currently not accessing enough. We think the power business is going to be the fastest growing segment of the energy system, and we just need to be part of that as well.
When you talk about accessing the Brent that's still there, the head of upstream at BP has said the world cannot produce all the remaining barrels of oil. Do you agree there? Do you think that your company is holding some stranded assets, so to speak?
Well, I don't think we hold stranded assets. I think the whole argument around stranded assets, and again, assets are, of course, those parts of the resources that we keep on our balance sheets as reserves. I don't think that is going to happen. We are going to, again, a bit later in the year, publish another report which is going to very clearly demonstrate that in the next 10 years or so, which is when these concerns are, of course, on people's mind, we have an asset base that is financially resilient. So I do not see that in the next years things are going to play out to the extent that we will have to take significant impairments on our oil and gas reserves or resources or assets. What we do think, by the way, is that yes, indeed, oil demand will peak before supply will peak, and therefore we will have over the next few decades the need to adapt our portfolio to remain relevant in what's going to be a changing energy landscape.